Hey guys, it's Willie. Today I want to take a glance at Verizon, a really boring telecom company. Let's see, over the past month and a half, you're looking at up 2%. Over the past 12 months, down 1%. You know, this is a slow-growing, slow-moving company. I don't think a lot of action would be seen on it, but I think right now it could be a good value play. You know, value investors are looking for more boring companies anyway, things we can wrap our heads around easily. So let's jump into our spreadsheet and see what we can figure out by glancing at the financials. Alright, so now that we're in our spreadsheet, let's start with our revenue. Revenue went from $110 billion to $128 billion, 1.5% a year over the past 10 years. Net income, it may seem like it's growing a lot faster. You're seeing 22% a year over the past 10 years. It's just because you're starting from this 2 billion number. If you look at from 2015 to 2020, you're flat. It's basically flat. So you're seeing it jumping around in here and it's sort of stabilizing. I think you're still seeing growth, but it's not as aggressive as it might seem here. But nonetheless, you're seeing good net income growth. Cash flow from operations, you're seeing that growing. Capital expenditures, that's growing at 1% a year. Not too fast, but it's a good sign that they're expanding their business and growing those expenses. Cash flow from operations minus our capex gives us our free cash flow. You're looking at what, $13.5 billion to $23.5 billion. So that's up $10 billion, 5.7% a year over the past 10 years. The next one is somewhat concerning to me. You're seeing shares outstanding going up, especially right here. You're going from 2.8 billion shares to 3.9 billion shares. There must have been an acquisition or something in there. At least that's what I'm thinking. Or, you know, the board at Verizon went crazy and decided to issue over 1 billion shares. Otherwise, you're seeing slow and steady growth over time. You're looking at 3.85%. On to earnings per share, you're seeing 0.85 to $4.30. Really fast growth, but that has to do with, you know, the crazy fluctuations in net income. Free cash flow per share growing from $4.77 to $5.69, 1.8% a year over the past 10 years. Really good. I think we'll kind of lean on this free cash flow since it seems to be more stable and it seems to be at a more reasonable growth rate. Debt is something that seems to be a bit high for me, growing at 5.5% a year. Minus the little bit of cash that they have, you get net debt. Net debt seems to be a bit high. However, I will say that Verizon has, at least according to the software that I pulled the data from, Verizon has assets that outweigh even this total debt number. However, I don't really get into the asset thing because, you know, they may have it on their balance sheet for, you know, what they paid for the asset, and the asset may not be worth that anymore. I mean, take any, you know, technology product that you buy. You know, take a cell phone, for example. You know, you pay $1,000 for that new iPhone or the new Samsung or whatever, and then, you know, say you hold on to it for 5 years. Well, you're not going to be able to sell it for $1,000 you paid for it. You're only going to get $500 for it. So I don't really get into the whole asset thing, but that is something to keep in mind. I think this is something that you should be looking into if you're interested in the company, which once I get to the IRR, I think you will be, as I am. Return on invested capital, the company's investing its money fairly well, you know, 8% average over the past 10 years. So not bad for an old company like Verizon that's doing a very boring business. On to our collection of metrics over here. Our PE, so our current PE is 12. Our PE based on the average of the past 5 years of earnings, you're looking at 11. Free cash flow, currently you're looking at 9. 5-year, you're looking at 14.2. So looks like it might be cheap, i.e. it is. Net debt to 5-year free cash flow, you're looking at 16 times. That's high. I'm getting a little concerned about the debt level. But again, solid free cash flow. They've got assets. It might be okay. I'm not entirely comfortable looking at it, just standing here looking at it. But, it may be okay after some further research. Revenue growth positive. Earnings growth positive. Free cash flow positive. Shares outstanding going up. I'd rather see it, flat or going down, but it's low enough. I'll give it a pass. Return on invested capital over the past 5 years is 10%. Good job, Verizon. On to our forecast. I put in 5% for free cash flow and 5% for net income. As we can see, net income, we can't assume it's going to grow at 22% a year. So I kind of ignored this. I think our free cash flow number is more of where we want to be. If we're assuming they keep growing at 5%, I think we're getting a good return. And then I assigned a 12 multiple price to free cash flow and PE. And then we come over here. You can currently buy it at about $53. You get our 2 share prices in 10 years. You're looking at an average of the 2 coming out to 97.63. If we come over here to our IRR calculator, you're in at 53. You get the stream of free cash flows here. You're out at 97.63. That is a 20% return annualized, which is significantly above market. 20% a year is nothing to sneeze at. I think that's Warren Buffett's average, if I'm not mistaken. So I think you're looking at a really good return. I would be willing to say you'd be looking something more at like the 3% growth rate, just because I like to be extra conservative. That gives you an $80 price target. You're still getting 18% annualized. Now let's go to the assumption and say everything goes wrong. How bad does it have to get before we only make a market return? Minus 3% growth, annualized 12 multiple. You're getting a 10% return. So, I mean, it would have to be really bad before you even got worried about how bad things would have to be before it, you were only breaking even. So I think Verizon is a very safe stock to be in. It's a very reliable, slow-growing company. I think it's worth doing some more research into the company. If you're looking at a 20% annualized rate of return, you're looking at something really, really nice. So yeah, as always, do your own research, do your own due diligence into any sort of company. I think Verizon, you'd want to look into the debt and see what you think about that and these numbers and see what you think. But do your own due diligence. And with that, I will end here and catch you guys in the next video.